All right, good morning. So today's SONAR update, I want to talk about a little bit about general market overview of what we're seeing in the data and regular seasonality. So while tender rejections did fall last week, really at their fastest rate since April, and volumes fell a bit, we did see an increase in domestic intermodal volumes, and you can really see those moving in tandem, particularly when you look at the long haul tender rejections. For over the road, they really are moving in line with intermodal volumes. So you can see those conversions really happening, particularly because there's really a strong cost differential right now between over the road and intermodal. So I expect to continue to see strong intermodal volumes. And so again, going back to those tender rejections and line haul rates, the last week of July, we did see continued declines in the spot market line haul rates. And while they were more aggressive last week than in prior years, the same week, we're seeing them continue to move along seasonal expectations. And I believe the reason that they were more aggressive last week and fell was because we'd had such a sharp and quick increase earlier in the year. So while spot rates did fall last week, as well as tender rejections a little bit, we're still hovering right above 14%. I want to remind everyone to look at the broader context and that rates still remain from a spot standpoint at record levels. Honestly, the only time we have seen them this high in recent history in the last 5 years was in 2021. So the SONAR NTI, National Truckload Index, even when you look at line haul only and back out fuel, it fell 7 cents per mile week over week from 271 on July 23rd to 264. So it is 12% lower than the 302 record, which was last month. But again, it's still 51% higher than the same level a year ago, which was $1.71. So we're also seeing contract rates continue to rise. So as higher spot rates continue to persist, we are seeing contract rates continue to now inch up. Recent second quarter earnings from a lot of the large trucking companies we have heard from recently are really falling in line and quoting that same concept. Trucking executives have talked about and showcased improving conditions at higher rate negotiations. So we're hearing all of them talk about operating margins improving, but at a slower rate as large fleets continue to reprice their freight mix. We've heard them talking about those contract rates finally coming up and then rising, coming up, and then also those rates that they're renegotiating really beginning to happen in July. I found it really interesting that many of these executives are all sort of quoting and saying very similar things, talking about being in the early innings still of this freight recovery and a tight capacity market. Schneider noted double-digit rate increases on contract renewals in its one-way fleet during its second quarter earnings. They talked about revenue per truck in its one-way segment rising 16% year over year. Their management described the truckload market as in the early stages of a rate recovery. Again, similar to what we've heard from quite a few others talking about the early innings. Again, in the Schneider earnings, they said that the company is using the capacity imbalance to recoup multiple years of cost inflation, and that mini bid activity is rising as shippers are seeking more peak season capacity. And we're finally starting to begin to see a little bit of intermodal rate increase as well. Schneider mentioned low to mid single digit increases with stronger gains in more recent contracts that they've signed. Werner Enterprises in its second quarter earnings said that its one-way truckload operation secured upper single-digit to double-digit contract price increases on some bids, and mentioned that roughly 60% of its one-way portfolio saw higher repricing in the first half of 2026. Again, all in line with us beginning to see increased contract rates. Heartland Express is an interesting one we've been watching. Historically, they've had incredible earnings, and they've had a bit of a blip recently, but we're starting to see more of what we would expect from them. Their recent Q2 earnings showed dramatic operating improvement, and they reported a 91 OR. which is a massive improvement year over year of what they were showing. And they cited stronger freight volumes and improved customer pricing resulting from ongoing industry capacity reductions. So all of this is showing better results for all of these large companies as we've seen increased spot rates, but now we're also beginning to see those increased contract rates. I think it's also interesting that almost all of them are quoting looking towards continuing to improve margin, profitability, and utilization before looking at growing. So I'm not seeing any indicators that a lot of capacity will be entering the market to change this current balance where we're seeing lack of capacity really leading to this strong freight market that we are in. So some of the graphics that we're going to show are that NTIL over the last 5 years so that you can see what's happening there this year compared to prior years where we are seeing, again, as I mentioned, still record spot rates, even when you back out fuel, higher than anything we've seen in the last 5 years. You can also see contract rates continuing to rise and that gap between spot and contract closing a bit as spot rates are now finally pulling those contract rates up. So as we've said in prior SONAR updates, well, I'll say it again today, contract rates are rising. I believe that this capacity-driven tightness will remain for quite a while.
Julie, I got to tell you, it does feel like we're repeating ourselves every day. And it's more of the same. The market's not changing, but it's not bad. It's good. Spot rates are near record high. It just feels like ultimately we're saying the same thing every day.
Well, I kind of think we are going to be saying the same thing until we get to the end of August, right? I think we're just in this normal freight cycle, normal seasonality. But what I do feel good about, while things aren't necessarily changing, is that everything that we have been saying regarding capacity not entering the market, rates continue to remain strong, regardless of fuel surcharge, on their own merit, spot rates and contract rates going up was also mirrored in earnings and the quotes we heard from CEOs across all of sort of the large carriers and those who we've been watching to report that they're not adding capacity, that their rates are coming up, that they're seeing June and July contract rate increases.
And we're in the first inning. We're in the early innings.
Everybody says early innings. Early innings.
We need to trademark that and get a royalty every time someone says it because they're repeating it all the time.
Yes.